Thank you and welcome, gentlemen. This panel is a combination of experts and two of our portfolio companies. Fintech is a new space, and we'd like to hear how things are shaping up. But before we do that, let's hear from Sanjeev, who is the co-founder of FT Cash, to share with us his journey and something about FT Cash.
Hi, thanks Ashish. From an FT Cash perspective, we enable MSME lending along with digital payment. So we see a huge opportunity in the country where millions of small businesses do not have access to credit in the right form factor, at least institutional credit. So we are enabling that. And we also enable, we also manage credit risk using our proprietary digital payments platform. My background has done banking for a while, so right before FT Cash was working with Deutsche Bank, left that because we saw a huge, immense opportunity in this space, along with actually helping people improve lives. If folks get access to credit, they can scale up their business, improve their monthly income, etc., which is fairly enriching. As previous speakers, I think like Ganesh and Mr. Pillai had mentioned, there is a lot of change happening in the fintech industry in the last couple of years. You've seen everyone getting into it, from tech like Google, Facebook, even the government getting into fintech. So it has been a crazy ride so far, but enjoying it.
Can you play the video, please? Thank you. Next, I'd like to ask Shubham to introduce, Grab on Rent and his journey.
Sure. Thank you, Ashish. So, hi everyone. So, Grab on Rent basically is a product rental marketplace, very much focused at the basic amenities of setting up a house, where we allow people to rent or borrow products such as furniture, appliances, and for corporates as well to borrow the basics of electronics and equipment across the various geographies we operate in. We're a very young company. We are just 3 years old, and right now cover up 4 geographies in India. And the basic essence of renting can also be, and maybe many of you would be wondering why am I sitting here in a fintech panel discussion. I think we really have to understand that consumer renting is very much related to consumer durable financing. And that's exactly how people tend to borrow not cash, but products directly from us. So maybe a very small journey, and you would definitely be enjoying a small video that we have put up.
Can we play the video, please? Great. We are also very fortunate to have with us today two experts on fintech. Christian Trum, welcome. He joins us from Germany and is an expert in this area. And also Akhil Handa, who is an expert in India in this space. Let's start with the two of you and to understand how what is fintech and what's going to be the dramatic impact of that. Are we saying banks are dead? Are we saying that banks are going to die? How does it transform? Can you just unfold what's happening, what the drivers are, and how the landscape might change?
Yes, Ashish, as you rightly mentioned, banks have a lot of problems in India with the non-performing assets and bad loans. Basel III capital requirements occupy banks, also management capacity-wise. But I think that the biggest problems of banks is traditionally hierarchy and very slow decision-making processes. And I think that's what's keeping them away from consumers, from change, from new technologies. On their asset side, definitely there's still some trust, high degree of functional expertise. And so what is driving the fintech market for me is all these technologies that enable people to be included, to participate, like farmers and small merchants in India, or Western consumers or the middle classes or the upper classes, also in emerging markets, are enabled to have a more mobile and more individual lifestyle. And I think that is what will be driving the market over the next couple of years.
Akhil, you would like the question, but obviously you are embracing technology. So how do you see fintech transform banks and financial services?
Sure. I think let's just keep the bigger picture in view first. In India, there is 108 lakh crore of formal credit outstanding. If the GDP of the country has to double in the next, say, 5 to 7 years, as is projected, there's a certain correlation that happens between credit and GDP. Now, there is a certain capital requirement that comes vis-a-vis doubling of this. So if you want to add about 100 lakh crore of credit into the country, where is that going to come from? Now, if it is not banks, it has to be someone else. Now, the starting position is, I do not believe that banks will be dead. Yes, some of the banks in the current format may get rolled up, may have to find niches, may have to up the game. But certainly banks as an institution play a very formative and a very important role in the allocation of capital in the ecosystem. And I believe as a whole, fintechs or no fintechs, NBFCs or no NBFCs, that intermediation needs to happen somehow. And that is a role I think that these institutions collectively will play. The color of that may change. Fintechs will also start assuming a larger role in the ecosystem. But that is a gradual process, and that is not going to happen over a period of, that is not going to happen tomorrow. And as Sanjeev would tell you, lending is the easier part. Collections is what is difficult, and that gets built over a period of time. That institutional memory, the processes, the training, it all takes a period of time to develop, and that does not happen overnight per se.
Great. So, keeping that context in mind, I mean, like Sanjeev, you're helping lending to you're building up sort of a payment like platform. How do you see this transforming?
So no, as Akhil said, right, I don't think we can generalize and say that banks will die. There will be survivors, there will be people who won't be able to adapt to the change. But no, I think the survivors or the surviving banks will have a lot of positive things going for them, so they will stay alive. I see a lot of partnership opportunities between banks and fintechs because they bring both of them bring some unique stuff on the table. But okay, so if you go back a little bit, right, or step back a little bit, I think consumer preferences are changing. So in the earlier panel, where we talked about that, women come in different sizes, they have different requirements, etc. Why can't it be for a financial service? Right now, the process we follow is, okay, I have a set process for a loan, take it or leave it. And unfortunately, the consumer has to go through a lot of hoops to follow that process. I think that all will change. I think the delivery will be more consumer focused. The delivery will be more convenient to the end borrower, because at the end of the day, they are paying for it. And they can demand that, you have to meet their requirements rather than the other way around. So I think a lot of shift will happen. I also see a lot of consumer companies coming in because they have cracked the nut in terms of figuring out what consumers want, how to satisfy their requirements, their taste, etc. And maybe they'll partner with banks, maybe they'll not, but I think this trend going on.
So at least banking will be alive, but the shape and size and form of the bank may be very different. Shubham, you are operating in an interesting segment. You're trying to Uberize appliances, home furniture, etc. Is the rent economy really big in India? Is it going to be really big?
Sure, thank you. So I'll tell you how did we start, and then I'll come to the question that you've asked. 2015, when we had begun, our assumption was pretty simple, that there's a lot of migration that happens to new cities. There will be a lot of fresh entrants to the metro cities for the first-time jobs. And there will be the people who will not have deep pockets to furnish an unfurnished house. There was 2014, 2015 were the time when a lot of young startups were coming up, right? And that was the time we thought that, again, the ones who were bootstrapping, the ones who were very mildly funded were the ones who would require equipment and office infrastructure. And that is where we started off to understand there could be a niche market, that people would want to not invest capital upfront and would want to borrow products. Our thesis was turned upside down in the last 3 years. So today, if I have to just put a case here, 60% of our audiences have stayed in the same city for 5 years or more. And the average age group that rents 50% plus from us is 32 years plus. Now that's strange as well as very interesting as a concept for the married people or more settled people to have being borrowing products. And this is where we see that businesses have spent centuries making buying really easy. And probably we are just in the first over of a test match, making sharing. So the shift in the behavior of initial assumptions of the migrants to the more settled people that we are seeing coming to our platform and renting products is a sign that there's a lot of many overs to come and not many people still to be adapted to the sharing economy of such.
Great, thank you. Let's talk a little bit about the consumer, because you're talking about customer shifts, right? Sanjeev and Akhil, both of you work in very different types of organizations. How do you see this customer shift? Why are customers flocking to you? And how are you making customers stay back?
See, again, I think if you look at the trends and the changes that are happening, there's an enormous amount of the pace of change is quite rapid, and we've seen that over the last 3 to 5 years, and it is only going to accelerate. In terms of if you look at the penetration of banking services, just the way the government defines it, it's about 80% right now. Internet penetration is about 10%. So the customers, 10% of the customers are able to do internet banking, are using. 4% is the mobile banking penetration. Now that, if you look back from the last 3 years, has again changed dramatically. And this is what I think fintech is going to do, is going to aid, is going to accelerate. Of course, there is certain arbitrage that comes into play in India when it comes to what a fintech company can do and what a bank can do, and which is what makes for a very healthy relationship between the two. Because there are very clear lines of differentiation that in certain areas, and I'm not talking lending specifically, there is payments, there's wealth. In each of these, the regulator has created certain lines of differentiation between what a banking license can do and what what a fintech company or a non-bank can do. Now, when it comes to our own strategy in terms of transforming, so while the bank is about 109 years old, so there's a tremendous amount of legacy that we have, right? We embarked on this transformation journey about 3 years back. And there are 3 things that we looked at. One is we will form core assets. There is not, we cannot outsource all our core activities. We cannot bank on on partners. And there are a ton of partners that we work with, not just the ones that we normally read in the newspapers. There are partners in the B2B space, there are partners in the collection space, there are partners in telecalling, customer contact centers. There are enormous number of partners that we work with, so we figured out there are certain core assets that we need to build and we need to in-source them. So that's the number one thing that we're doing. So we have an IT center of excellence, we're building an analytics center of excellence, and these are the core assets that we'll focus on. The second is develop a band of an open banking platform towards partnering. And that is where we partner with players like FT Cash. We have about 32 partners as we look at right now. And they, again, range from across the financial services spectrum. So from lending to wealth management to payments to technology to capital markets, asset management, insurance. And we just want to open a platform such that players who want to develop innovative solutions can probably innovate faster than what we can do. Should come and plug and play into our system. That's the second one. The third is investments. Now, whatever we feel is extremely critical or is something that is probably non-core, and these are two opposite sides of the spectrum. We take an investment position in them by way of a fund or by way of a direct investment as well. So this is largely the strategy that we are following to transform the bank, and as a result of which, you see this has results right from the customer touch point, the form factor, all the way to the core systems that we have.
Sanjeev?
For us, no, it's fairly simple. There is a lot of pent-up demand in the country. What we find is that, most banks, there is a lot of, there are a lot of banks or service providers at the very high end. So, most banks will, gladly lend to the corporate sector, a few 100 crores sort of exposure, that sort of thing. There is also a lot of supply in the microfinance area, right? So the microfinance area took off quite rapidly a few years ago. And then a lot of people have got into it. But there is a big missing middle where there is not enough institutional credit. I think we are going after that. We are keeping it simple. We understand the customer psyche, the dynamics of the customer, which helps us control the credit risk. And we provide them access to credit in a convenient form factor that helps them come back again and again.
So I'll come back to you on that segment that you're going after. I have a few questions, but like Christian, coming back to you and understanding, you've seen lots of fintech companies across the world, right? Mm-hmm. What do you think are critical success factors for these companies? Which companies will succeed? What do they need to do to succeed?
Well, I think as a fintech company, you're a startup like in other sectors, so you've got to be entrepreneurial, you've got to be experimenting and very creative. At the same time, fintech is different from other industries. it's highly regulated, and you're dealing with other people's money. Not just your own money that you can burn, and not just VC investors who may have a high risk appetite and a different take on that, but you're dealing with other people's daily funds. So the biggest challenge for me is always to combine the forward-looking, very young culture of the startup scene, which is in other countries, in my opinion, much younger than in India. So I'm always amazed to see a lot of mature people here also, and other startups, particularly here in the IvyCap Ventures portfolio. And at the same time, you need more mature people in a fintech a company that can talk to regulators, that have a slightly more conservative take on things. And combining that and giving customers trust, and at the same time making lives easier, is for me the biggest challenge. And that is the trend, in my opinion, will be creating value that is actually seen by consumers, giving them access to finance, giving them access to investment opportunities, and at the same time blending into digital lifestyles, giving them a seamless customer experience.
So yeah, let me come back to you, Sanjeev, with that, right? Because what we're talking about is it's regulated, you're dealing with other people's money, but you're trying to serve a need. And you said you're going after a certain segment which is underserved. What if I push back and there's a school of thought or an opinion which says that you're going after a segment which is very high risk, you're burning money, and it's not going to pay off?
Interesting, right? So I think it depends on how you look at the segment, right? So as Christian said, right, I mean, you have to be careful when you are lending. You are lending other people's money. You have to treat them as your own. You have to manage risk, especially the credit risk side of the things. So to Ashish's point, right, it's not that these folks do not get credit today, right? They don't get institutional credit, but they are all, when they need money, they go to money lenders, they go to other sources of informal finance, and most of the times they pay back the money lenders, etc. So I think this is a game of managing credit risk, and the other thing is that these folks are ready to pay a premium for access to credit. So from a unit economics perspective, if you are able to manage credit risk, this is a fairly good segment to be in. I used to work in subprime lending in the US, and we used to make fairly good money because we were able to manage credit risk. So as long as you are able to manage the credit risk, it is actually a fairly good segment, because you and I will shop around for 2 basis points, 5 basis points, but these consumers generally don't do that.
Again, you raise a very important point on credit risk and credit engine. Let's park that and come back to it. But I want to go back to Shubham. Again, one of the points that Christian mentioned was solving customer needs. And you deal with a variety of customers on a variety of appliances, financing them, in a way, financing their needs, right? How do you really, how do you deal with a set of customers who may have very wide range of needs from a quality and service and even perception about that?
Sure. I think it's not very specific to a business like ours. I think every consumer business has to understand what a customer may want. And varying age groups, varying geographies, varying interests also make a business like us in the initial stages compelling enough to understand what the customer actually wants. So just to give you an idea, we only had a very limited selection in the initial days because we were really worried. The moment we expand our selection, there could be a lot of leakages in the quality. So this was something like 2.5 years back. So this also became one of the strongest learnings for us, when we tried to understand that there was a change in the age group of people, there was a change in the geographies that we were working with different type of consumers, the choice is also different. So today, if somebody goes to our platform, grabonrent.com, so based on different age groups, we have different selection that we offer today. So for example, a 25 years old lady comes to a new city, would want to set up a house, will have the most economic needs, a bed and a mattress, a refrigerator, washing machine, which are most economic in the monthly rental prices. Whereas a 35-year-old couple would want to have more aesthetically designed furniture, more designer curtains, more designer sofas, the better living arrangement, right? And that's how we've evolved over the selection as one piece. So does our marketing also represents that whenever we present our offerings to our customers across various digital platforms. So we also attract them via different kind of selection that we have. Secondly is our business is something which will not have brand new items always. Right? It's a cycle. It's a 3-year cycle in which a customer rents, returns to us, we refurbish it, and then deploy it to a new customer. So it becomes very important to have a strong refurbishment unit, right? I don't know how many of you actually took a look at the video. There was a small piece which describes that there is a proper UV cleaning, there's a foam cleaning, there's a proper washing that happens of every fabric furniture, and there is again a UV cleaning that happens for every electronics. So this is not also very operational heavy because these are all done via specialized machines. So initially we had humans to do it, now we have a pool of competitors, pool of cleaners who are very much trained with highly efficient machines who are able to churn this like in just minutes. So earlier we used to have about 5 products an hour being cleaned. Today we have 25 products being cleaned per hour. So that's how we are improving the efficiency of maintaining the right quality and the right selection across the different geographies and age groups.
And Akhil, how is technology helping a traditional bank create new products for customers?
Yeah, to the question, I think, a bank like ours, today when we look at the customers, in our FGDs, what we figured out is we need to make a lot more customization effort, in segments, and especially when it comes to, the MSME segment per se. And MSME, and the smaller ticket MSME segment is where the customization needed, and of course then in the larger ticket sizes, that's a very different ballgame. Delivering at scale cannot be done individually, cannot be done on paper. It needs a certain technological intervention, a platform to come in to deliver and to meet the needs of the consumer. Now, in many of these cases, the first challenge that we have is our own mindset. What we figured out is, if we do not change our mindset to start delivering to the customer what the customer is asking for rather than what we have, the customer will move to the next shop. And I'll give an example. When we were looking at setting up a new desk for lending to cab aggregators. Now, cab aggregators, there depending on who you ask, there are about 10 lakh cars attached to certain cab aggregators in the country, and that number they want to scale it up to 10 times. Now that cannot happen if the banks do not lend or other financial institutions do not lend. And looking at the performance of the books of certain initial lenders, we were about to err on a conservative side that we do not want to lend to this segment. Certainly not to a segment which is as per our scorecard we would traditionally consider subprime, because one component was he was less educated than a person who is more educated. Nonetheless, we established this program and we had 3 buckets, A, B, C, in which we were able to classify the pilot cases. Surprisingly, what we figured out is the performance difference between A, B, and C was negligible. And the reason why that happened is because the mindset that we were starting out with, that this customer is probably subprime because of X, Y, Z reason, which is, is he married, unmarried, how long has been driving. the education profile was one thing that was completely turned on its head. What we figured out was a borrower or driver which was actually less educated up to the 10th standard was a better driver, was a better borrower than a graduate. And that is, that is once you start doing these things, you realize that, there is a need to change your own mindset. And of course, once the mindset changes, then you're able to get in other interventions as and when required.
So again, a fantastic example, and it goes back to the question you raised about, credit engines. Sanjeev, you've done credit work in the US, subprime, in India, with large international banks. Now you're building a completely new credit engine. How is it different, and how does it help you leapfrog some of the limitations that a traditional bank or a financial institution would have? And Christian, related to that, in your experience from international companies, how are younger companies able to use data and AI to build much better credit engines? What has been the experience internationally on that?
Data, I think we are only in the infancy of artificial intelligence and development. It's ideally you need a lot of data available, like in China, where almost 1 billion consumers are generating a myriad of data every day on their mobile devices, and it's legally available in that country. So you need all the data to be able to experiment, to build hypotheses, and you may get surprising insights, as we just heard. And at the same time, the data must be available on the spot in real time to be relevant. Banks usually have the problem, they have all the data in the world somewhere on their records, but that's just somewhere, and it's not available when you need it in the right granularity and within a meaningful amount of time. And so there's two components. First is, of course, risk estimation in financial services is pivotal when you're in the credit business to estimate, is the customer credit worthy, but it's also in terms of opportunity. So you must, as we also heard in the previous customer experience panel, customers are worldwide more and more demanding when it comes to individual solutions. There's different segments, and that may be also surprising. In the West, we don't think we have a problem with illiteracy, but we do have a huge problem with digital illiteracy, because aging populations, people just don't care. They don't have real pain points. They think they've got it all. And to address those people, you must cater for different segments for older people. And for that, you need data. You need to test out what works. How can you address them? And individualized when it comes to bot technology, of course, you need all the data available, and you must learn from past experience. What was the churn rate in e-commerce? What was the response to communication with them? And how did people react to certain impulses you sent out to them?
Sanjeev, how are you building a better credit engine?
Yeah. So I think, credit has to run in the DNA of the organization, right? If you're building a financial services company, it has to be in the DNA. And you have to build for the segment rather than having one credit process, one philosophy. And what works for a manufacturing company, that has a lot of collateral and is taking a 100 crore loan is absolutely not going to work for somebody, where you're doing a unsecured loan for 2 lakhs, 5 lakhs, etc. So it has to run in the DNA. You have to build for the segment, build for the customer, rather than the other way around, where you say, okay, gee, I have perfected a process for a 10 crore loan. I'll use it for a 2 lakh rupee loan. That simply doesn't work. For us, the reason why we are different is because, once again, we have built for this MSME segment. So one example I'll give you is, usually when you do a traditional loan, right, you get a risk signal once a month. Once a month, when your EMI check goes through or your check bounces, is when the bank knows whether this customer is still standing or is dead or potentially going to go bad. we get multiple risk signals every single day. So no, we get no order of magnitude more risk signals from what a traditional lender will do. And that's how we build the product, that's how we build the systems, the processes, etc. So now we are processing those risk signals, we are understanding what's happening with the customer on almost a real-time basis. And we are able to engage with the customer much before than what a traditional lender would even know that something is going wrong. And based on my experiences with credit is, if you engage with the borrower early on, chances are you will be either able to save the account, you are the first lender in the queue to get your money back, and most likely your NPAs would be much lower.
Great. I think we are running short of time, so I'll ask Shubham and you. You are the youngest companies in our portfolio. And I think in terms of evolution, and it's been a great journey so far. But how do you see yourself in the next 5 years?
So I'll take that first. So yes, so what we are trying to build today is a very simple line of credit for the people who wish to borrow assets for their homes and offices, right? And the majority of the motivation that we have is inspired from our own experiences, from our own peers, and understanding that how many of other people like us who will be migrating to the new cities. Just for a fact, last decade, 2001 to 2011, 100 million people migrated to urban areas. And this number is going to be 1.5x this decade, right? It's already doubled by next decade as well. So if this is the case, there's a huge population who will be coming to the urban areas and requiring many assets to be furnished in their houses or offices. So it may not be just limited to consumer durables, as Sandeep rightly mentioned, that there will be a lot of credit analysis to be done for these audiences. So we are focused towards upgrading their lifestyles, that we should be there once we are able to create that kind of technology layer to receive those kind of people, the inflowing audiences, to be able to give them what actually would be required for their the entire credit line. So be it the risk assessment, be it the assets required for them to be deployed in the houses, be it the selection which is to be presented for them to choose. And I think that adoption is a journey that we are going to be living. And the entire opportunity which we see in front of us is a $10 to $12 billion opportunity. And as I said, it's just been 3 years. It's just scratching the surface of the entire sharing economy in India. Taking a cue from the US and the European companies as well, it has taken a substantial time for economies to raise their bar against buying as the preliminary way of consuming products.
So in the next 5 to 7 years, we want to be the most trusted nationwide lender, where customers expect us to do the right thing all the time. We want to partner with our MSME clients to help scale up their business and improve their lives.
Great. Thank you, gentlemen, once again for a very insightful session. And Shubham and Sanjeev, congratulations on the companies you are building, and all the best for the future. Ladies and gentlemen, thank you for your time. I hope you've had an insightful morning listening to our companies, and I'm sure there's a lot of food for thought. They will be around, unfortunately, because of time, we have not taken questions. But obviously, they're around for you to interact with and learn more about what they do. Thank you.